What if America's safest jobs weren't safe at all? And tomorrow, your neighborhood's home prices started falling, not because of mortgage rates, but because the giants powering your city just started laying off thousands. The first domino just fell, and the shockwaves could be heading your way. Now, let's pause and wrap our heads around that picture. We're not just talking about another tech bubble headline or another round of startup drama. We're looking at a scenario where the giants of American industry pull back at the same time, pulling income, stability, and optimism right out from under entire zip codes. Will this be the moment that turns America's housing soft landing into a crash landing? And here's the kicker. If you're living in a booming Sunbelt city or parking your savings in a tech suburb, you might be right at the epicenter. Let's go interstellar for a second. Think of the job market as a young star, bright, burning, and full of energy a few years ago, but the fuel isn't infinite. Over the last 6 months, beneath those strong labor market headlines, we've seen a chilling trend. More than 100,000 American workers, many of them with six-figure salaries and golden resumes, have had the rug pulled from beneath their feet. And these aren't the easy-to-dismiss gig layoffs or retail reshuffles. These are the jobs that powered entire urban galaxies, so to speak. What changed? Blame gravity. Or in this case, interest rates. Companies that once borrowed freely and expanded fast suddenly have to tighten their belts. The era of cheap money is over, and with it, a decade-long run of relentless hiring and sky-high housing demand. Now, as leading employers get lean, there's a gravitational pull drawing markets downward, and the companies making the deepest cuts, they're also the ones that turbocharged their regions for years.
Let's start with Amazon. Sure, we all know them as the online retail gigantic, but Amazon also quietly rewired the housing circuits in cities across America. Amazon isn't just losing a few truck drivers. We're talking about nearly 14,000 workers across corporate offices, logistics centers, and management. Folks whose incomes set the pace for the neighborhoods around them. In places like Tampa, Orlando, and Charlotte, each new Amazon facility meant scores of renters and buyers, developers swinging hammers, and small businesses thriving on the spillover. But what happens when those jobs disappear? Here's what's already unfolding. Local sandwich shops and coffee spots near Amazon offices say foot traffic's down by as much as 30%. Realtors who once filled their schedules with Amazon relocations now spend their days cold calling. Developers, once building entire neighborhoods on speculation, suddenly hit the brakes, shelving project halfway. For the first time in years, landlords are offering free rent or giving out parking perks just to fill units. That's the ripple effect. It's never just one company or one worker, it's the fabric that ties entire communities together. When Amazon hiccups, the whole town catches a cold. And if Amazon's tremors are national, Google's shockwaves are regional, especially if you're anywhere near the Bay Area.
Now, about Google, technically Alphabet, but let's call it Google because everyone does. They recently let go of 12,000 employees, turning the volume way down in some of the most astronomically priced housing markets in America. The difference? These weren't just support staff, these were the coders, the analysts, the people whose massive paychecks built Mountain View's million-dollar starter homes and powered the school districts of Palo Alto, Sunnyvale, and Santa Clara. And just as jobs dried up, Google's ad revenue took a dip, down close to 8%. Suddenly, that meant fewer transfers, smaller bonuses, and less desperation from families willing to pay $500,000 over asking price. You can almost hear the chain reaction clicking into place. Here's how it looks from the ground. Property tax revenue loses its usual sizzle, just as schools start pricing out program cuts. Home improvement businesses see their phone lines go quiet as people delay kitchen remodels or cancel that pool project. Restaurants that once thrived on Google traffic see slower nights, while appraisers start downgrading property values based on sluggish sales. The bidding frenzy for new listings taps the brakes. Homes that used to get a dozen offers now might get one, if they're lucky. But the dominoes don't stop in California. Remember, many of those Google paychecks ended up buying homes in Austin, Boise, Phoenix, and Denver. So when the Silicon Valley belt tightens, even far-off Sunbelt cities start to feel the chill. If that's the reach of Google, wait until you see what happens when Tesla takes its foot off the accelerator.
Tesla's layoffs don't just jolt one zip code, they career through entire regional economies.
In Austin, Fremont, and up-and-coming Sparks, Nevada, Tesla didn't just employ, they inspired municipalities, spurred thousands of new housing starts, and turned empty lots into bustling neighborhoods. When 14,000 Tesla jobs evaporate, you feel it everywhere. Suddenly you see builders freezing new construction halfway, worried that demand will evaporate. Entire rows of new cars lingering unsold on local dealership lots. Home listings climbing as workers preemptively try to cash out before prices start tumbling. Others hanging on, start tapping into home equity credit lines just to keep up with rising bills. And here's the cosmic irony. Sky-high interest rates aren't just making it harder to buy a Tesla, they're making $600,000 mortgages look like moon landings. When monthly payments shoot into the stratosphere, both cars and homes start to feel distant, maybe even unattainable. Treasures. Let's take a detour to somewhere a little more magical, at least until recently. Disney, the world's largest theme park operator, and, for thousands, more than a place for dreams, it's the bedrock of Central Florida's economy.
But even the Magic Kingdom can't wave the layoff wand away. With over 7,000 jobs cut recently, Disney sent a chill through Orlando and its vacation-heavy burbs. Disney isn't just about rides and costumed characters. It's a web anchoring contractors, restaurants, hotels, and Airbnb investors. Each one depending on a steady stream of paychecks and tourists. When Disney trims the roster, you see ripple effects like this. Hotel construction near the park slows to a crawl, with cranes sitting idle and new builds on ice. Short-term rentals and vacation homes begin piling up on Airbnb, with hosts slashing prices to fend off vacancies. Cash-strapped restaurants reduce hours, or in some cases, close their doors quietly. Landlords who once relied on tourists and traveling workers are suddenly struggling to cover the mortgage, watching the first hints of foreclosure pop up around Kissimmee and Davenport. What's important, it's not just a Disney story. Layoffs from Meta, Intel, UPS, and Walmart, all at scale, start compounding these conditions. It's less about single companies and more about a convergence nobody can ignore.
Now, if you want to see how all these threads weave together, let's zoom out for the big picture view. History is an excellent, if unforgiving, teacher. Every time a core employer trims fat or faces a shock, the housing market inevitably catches the cold. Remember Seattle with Boeing layoffs? Vegas when casino floors went dark in 2008? Houston during the oil bust of 2016? That pattern repeats. Layoffs, population growth stalls, demand cools, houses spend longer waiting for buyers, prices peel back. Recoveries drag out for years, not months. The twist this time? It's not just isolated cities. It's happening across both the Sunbelt and the so-called Tech Belt. The hottest housing destinations of the past decade are now showing the earliest signs of cooling. Let's put Florida under the microscope for a moment. Over the past 3 years, Miami, Tampa, Jacksonville, Orlando, and Naples became stars on any real estate investor's map. Fueled by migration, investor hype, and dirt-cheap mortgages, the whole state seemed unstoppable. Now, the tide is pulling back. Inventory in markets like Miami and Naples is rising, sometimes by double digits. Median days on market keep stretching longer, especially at the higher end. Price cuts have become routine, not rare. Builders who once had waiting lists for luxury condos are quietly shelving projects.
In Miami, where folks used to joke about $500,000 shoeboxes, the stack of unsold listings is growing taller by the week. Jacksonville investors are ditching rental properties before the numbers get worse. Orlando's once booming housing market has flatlined following Disney's moves. Naples and Sarasota are seeing even the formerly bulletproof cash buyers holding out for deep discounts. Now, let's be clear, Florida isn't in meltdown, but the fever is breaking. And this pattern is creeping into Austin, Boise, Seattle, and the old reliables of Silicon Valley too. Every hot market built on easy migration, tech wages, or pandemic-era euphoria is now up against the same wall. If you pay attention, every slow-moving listing and every new price cut is another clue in the cosmic puzzle. None of these downturns start with lightning. First comes the slow drift. Supply builds up, buyers get cautious, and before you know it, each normal listing becomes a bigger neon sign that something's off. Every small downward move on price resets the comps, and each foreclosure nudges lenders to pull back, making cash harder to get just when the market could use it. And so here's where it gets real interesting. If these job cuts keep spreading, which housing market is next? Is that your warning sign to hunker down and wait? Or, depending on your view of the universe, is it the signal you've been waiting for to make a move of your own before the masses do?
All right, astrophysicists and market explorers, that's a wrap for today's deep dive. Keep your feet on the ground, keep your eyes on the data, and don't forget to smash that like and subscribe to Housing IQ, where your financial future gets just a little more clear, one orbit at a time. See you in the next one.